Hey everyone, and welcome back to another video. We've seen recent volatility come back into the markets with the Nasdaq sinking as low as 1.7% and crypto markets across the world starting to falter again. Is this a sign of the recovery waning or some kind of new correction beginning, or is it really just a blip on the horizon ahead of the big news, the CPI data? We'll be discussing our thoughts on the S&P 500, Nasdaq, Bitcoin, crypto markets, Tesla, gold, US oil, and more in this video. There's a lot to cover and plenty of great levels to discuss. Stay tuned, guys. This is sure to be a good one. All right, everyone, and this begins our market recap for the markets closed 9th of December 2021. And here we go. Look at all of these red stocks. It wasn't necessarily horrible across some of the bigger stocks. A lot of the FANG stocks like Microsoft, Apple, Google held quite well. Amazon got sued, it looks like, or they actually got fined in Europe, so that caused them to go down a little bit. And then we have here Tesla down 6.1%, back down to the 1,000 support level. Nvidia faltering a little bit, AMD down, and some of the hyper stocks were the worst hit. So let's now take a look at the actual sectors and the indices. So the Dow Jones, little surprise, didn't really move much. 0% for the day. So was it an across-the-board selling event? Not really. Then we had the S&P 500, did sell off near the close, kind of just faltered and hovered around all day. 0.72, slight sell-off near the end, which may be interesting when we think about the data that's coming. And then we had the Nasdaq down 1.49%, and the Russell 2000, the worst performer, straight back into the previous resistance acting now as support, which we'll look at soon, 2.26% down on the day. Let's move over to the sectors. Which sector was performing well? Which sector was performing poorly? Well, it turns out it was nothing really doing that well, but IBB, the biotech sector, and consumer discretionary were the worst two, and the more defensive sectors were hovering up. It doesn't mean these defensive sectors have had super strong weeks or anything like that. We have had, of course, technology really leading the pack. But I think we always need to put things in perspective. How much has the market gone back up? It's floated higher over the last couple of days, and we had about a 4 to 5% move. That's an incredible move. You do expect usually in markets 2 steps forward, 1 step back if it's acting technically. So it's not necessarily time to panic yet, but we will look at the key levels where we can start to panic should they be broken. Let's move over to the Santa Claus rally. Many of you are aware that this comes once a year. Of course, Santa comes to town, and then Santa going back to the North Pole. This happens over that holiday period. There's a lot less liquidity around this time as well, so a lot less Wall Street trading, a lot less algorithm trading, and it does tend to be a lower volume period. Now, is it positive? Yes, the rally is a real thing. You can see here in the stats, the rally is notoriously pretty good. It's actually a fairly decent stat in the markets, and while it may not net huge percentages, it certainly can do 1% to 2% in some years, and this is something that's very important. So between these dates, we do tend to see the market being quite positive, and that's something of importance. Another thing that's come up a lot throughout the week of trade has been the discussion of gaps. Now we have this chart here from Ian Worthington. He tracked from 1927 on the SPY all the way to 2021 in October and figured out how long it takes to fill gaps and whether gaps were filled. So usually it's around 20%. You'll notice the second day it's 10%, and then it drops off significantly. So for a gap to fill, it usually fills kind of within that first 5 to 7 days. If it doesn't, it can take some time. And then of course, all the other gap fills that do occur, being upwards of 75% of gap fills, really occur due to corrections. And this is only for up gaps, but it's an important stat and something that you might want to bring in to your analysis when considering stock gaps, when considering index gaps, etc. Let's move over to the fear index. This is where we always start at the moment. This is the VIX, the fear index, based on the options volatility. It has bounced due to some sell-off in the Nasdaq, but not that huge. It's still above 20, 21.57. We saw it dip straight underneath 20, but only barely. And this is where some VIX, I guess, hodlers or people that were trying to buy it may try to pick it up later on. Now, we do know the VIX can't stay up forever. If you go through a chart over a long period of time, while volatility can enter the market, e.g. over here, it tends to have those times where it comes really, really high, sells off, another volatility spike happens, and then it declines. Now, why does it happen like this? Well, I always argue it's a lot because of this type of thing, where basically we have that movement up, So that we have the crash to begin with, that creates the volatility. Then we have the movement up, that creates the decline. Then we have a new correction or minute movement down, which is more like a swing trade. That creates that increase. And then of course we go back to standard and the market starts to just recover and the VIX starts to subdue or flatline. Now this is very standard. In certain times, like we saw with the pandemic, sometimes it can just go vertical, 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 vertical for a long period of time. This is very rare. If we scroll out even further, it just doesn't happen that often. Look at the last time it happened. Usually it's less likely to hold up. It'll fall down after that initial spike, and then it will have a second resurgence as per the market actually starting to sell off again in its swing-based format. We'll see that very soon when we look at the charts. Let's move over to US oil. Now, Brent and US oil have done really a very similar thing here. We had that Wyckoff bottom, which of course had the massive false break to the downside and full resurgence. This is a positive sign for markets in general. It kind of shows us that OPEC, who really are kind of like the cartel of oil, they've managed to keep it up. And while governments are trying to push oil down, at the same time, we're seeing OPEC limiting supply and playing the kind of normal game they do. Now we have here resistance over on the left-hand side. We've got resistance, resistance. We haven't quite closed above this zone yet. And if we do, is that going to be significant? Yes, we've argued it will be. Over here, we have some resistance and support at around that 75 area. So this is where we kind of expect if we get a closure above, we move above to that 75. But for now, how does oil look? Well, many people will be spotting this zone, 69.50, 69.40, previous resistance during that Wyckoff event over here, the accumulation base. Comes back down. What if we get a lightning bolt? What if we get a double bottom here on the smaller time frames? Will that be a positive buy signal? I think there'll be a lot of people very interested in this level should it come down and do the right turn. So oil, it's been trading really well. You guys in the community have known what to do with it many, many times now. And hopefully it continues to be very technical as it has been for all of 2021. It's been a fantastic trade here on the channel. Let's move over to gold. Now this is lackluster to say the least. I mean, gold has been frankly boring in the last week. We saw that resurgence, we saw that movement out, which looked like we were going into an early November into the December, we know, seasonal event that's happened in the last couple of years, and then it fell like a knife. I mean, this thing was impossible to catch, and now we're stuck in all sorts of mess. I mean, we've got moving averages, the 50 exponential, which is the blue line, the 20 exponential, which is the red line, and the 200 simple moving average, which is the green line, all hovering around here. For gold to do well, it really needs to close above this zone and, of course, move through our most important area, which is 1810. We get a closure above 1810. I have an alert there. I'm sure many people do, and you'll be reassessing the market at that stage. What can happen? Will it go into the seasonality of the last couple of years, the December pulls? Here's the start of December. We can see what happens. If we go back over, here's the start of December, positive. Here's the start of December, positive. Now, that's only for the last 4 years. It doesn't mean it's going to happen again. It just means that if you do start to see some technical bullishness come through, that you might feel a little bit stronger about that technical bullishness because you have that seasonality with it. At this stage, I find it hard to short gold. I also find it hard to long gold around this price. I just don't think it's kind of indecisive. It doesn't really know what it wants to do just yet. Silver's very similar, though silver took a massive dive overnight, over the session. And if you have a look here, bang, resistance, resistance, resistance. It never got through and it just sold straight back off. Is it still on support? Yes, you would argue it is. Do I like that zone? Not at this stage. We're still looking at that 2260 plus for silver to get exciting. Let's move over to Tesla in the stock market, and Tesla remains on the $1,000. So it's come back down. It hit that 20 moving average on the daily. It sold off that zone, and it kind of reminds me of something we've seen previously on Tesla, where it kind of hovered between the 20 and the 50 for a little bit. It found the support, it found the resistance, it found the support, it found the resistance, and then it breached one of the sides. We do start to see this sometimes happen where the moving averages, especially a 20 and a 50, trap the market price. So will 1,000 hold again? This is certainly a key zone. If we're going to get buyers, they're coming in around this area. And I think now we breach that 20, that'll be the big deal where we start to move towards that 1170. So there's going to be some great levels here on Tesla, whether it happens on Friday or whether it happens later on in the next week. I think there's going to be some nice zones. We breach underneath with the daily close. Next stop could be $900. We breach above, as we mentioned, next stop 1170. So Tesla really getting trapped up here, which is good news because at least there's some technicals at play for now. Now let's move over to Apple. Apple sitting around this 174.23. Did not drop as much as I thought it would. It dropped a little bit in the post, another 0.19% down to 174.23. But realistically, this is just showing a little bit of weakness here on this candle. And I mentioned it in yesterday's video. We do have a lot of calls expiring for the Friday session at 170. So wouldn't it be surprising or pretty interesting should it get underneath 170? That is not a sure thing. It just shows you, if it does happen, how the options market can be kind of manipulated and how Wall Street do these things. But there's no technical currently other than a small rejection showing weakness. I think that traders will be looking at this from a smaller time frame. They'll be dialing in on it. They'll be looking exactly at this level here, which is around that 174 flat. And they'll be saying, okay, if we close underneath this on a smaller time frame, this could bring the shorters in to get us back down to maybe like a 170 level. That would make sense. I think it's a key level. We've also got some nice resistance around 176 because we're kind of trapped here on the 1 hour chart. And as you dial into the smaller charts, you can start to trade these little movements. But in essence, Apple still looks very long. It looks good on the weekly. I mean, this thing is just a powerhouse. It snapped all the previous rejection wicks, and that's just got to be a positive for it, for the investor, for the longer term trader, that they're looking at it from a positive standpoint for sure. Let's move over to IWM. This is the Russell 2000 small caps, and it's come down to a really nice level. Previous little bit of congestion down here is being tested. So let's have a look at it on the 2 hour. So there was a lot of moving averages you saw above there. They're all sitting around this kind of zone on the daily. If we now find the buying pressure here, which we expect to do so, we've got previous support, resistance, could act as support. We get the turnaround story. We breach this resistance. Fantastic. Many people are now calling it an inverse head and shoulders with like a double head over here. So here's the head, here's the left shoulder, and here could be the right shoulder. Yep, it doesn't matter how you want to look at it. It's a good pattern regardless. Should it hold this zone, we're looking for lightning bolts. We're looking for double bottoms. We're looking for some sign of buying pressure coming off this previous resistance. This would be a great positive here, and a breach through here will be happy days for Russell 2000 traders. I think that it does look very, very nice here on the charts should it get up to the right correct areas. Let's move over to the QQQ or the Nasdaq. Again, weakest market for the session other than the Russell 2000. We saw some strong selling. It was down considerably throughout the day, and that's because it went up a lot. Let's put this in perspective. If we have a market going up in a few days, 5.66%, you've usually got to expect some selling pressure to come in. There are negatives coming in. We've got the CPI data. We've got the Evergrande situation still kind of default this, default that. Not that I think that's the biggest deal anymore, even though it is a really big issue. It's being fixed as far as we know from the information we currently have. Now, the QQQ hit the resistance or just got close to it. It's sold off. Now what we start to do is we say, okay, well, what would a swing trader do here? They'd push it up, it gets moved down, and a swing trader would be looking at picking up a new price with the idea of it breaching and going higher into the end of the year, into potentially that Santa rally. So we can bring in things like our Fibonacci retracement levels at this stage, and we can say, okay, where's the most likely area for the market to come back down to? And I think that brings us to something like a 38.2 fib or a 50 fib, this area here. So this is where a lot of people will be interested in picking it up around that 390. Now, is that much of a drop from current price? Not really. I mean, you're looking at about 0.81%. Does it make sense there might be some buyers here? I think so. You've got support, resistance, and a really key zone. So this is an area I feel like if we continue to see some shorting pressure, let's say if we do, this area here makes a lot of sense for some buyers to come in. Now, a lot of people argue, well, shouldn't we just fill the gap? We might wick down there. All of this zone is where bulls will be in. And that's why I say it's hard to be a bear once you get so much busting through, because all of a sudden you've got buyers at 38.2, you've got buyers where it closed today, you've got a lot of buyers around this zone here. There's heaps and heaps and heaps of buyers. at all of these levels, at least from a technical perspective. The sellers lost really control once it got back above this zone here, once it gapped through and got here. The Nasdaq's the same thing, as you guys would know. It's right around this level here, right around that 16,000 that you're starting to target. Again, that's a psychological number. It's a big deal for Nasdaq traders. Let's move over to the SPY and the S&P 500. It's similar stuff here. We'd be breaking it down, going down to a 2 hour, looking for that fib retracement kind of level. We move the fib in. Where's the 38.2? Oh, lo and behold, it's around that 462. And then 460 has the 50 fib. So somewhere in this area makes sense. And if we go back over to the daily, you'll notice there is literally a daily 20 sitting right above or right around this 38.2 fib. So what has been previously support on the left-hand side could also become support again. We know it acted as a bit of resistance here. So it's not like the S&P 500 isn't paying attention to this 20 moving average. A pullback back to this zone, more than usual, and then hopefully a recovery from around that area upwards of these new peaks. It still looks positive as far as we look at it. Now, a lot of people are saying, but Tom, what about the volume? The volume has dropped off significantly. It certainly has, but I think we also need to remember that volume does tend to drop off after these correction periods occur. I mean, here we had a huge volume drop off. Then we get actually quite a low amount of volume going up. Yet that was still a true trend. I mean, this thing trended for days with low volume. Here we are with the volume we've seen today. Now, as long as it stays within this range of volume, we'll be okay. If it's down here, really, really small amount, then of course, yeah, well, we need to pay a lot of attention to why is it so low. But at this stage, I think it's okay. SPX is the same thing. We're just looking at the different levels and price ranges. I thought I'd give that to you. So it's about 46.25 for the 38.2 fib. And then a 4,600 for the 50 fib. So you can see in that zone range there, there's probably going to be some bulls, some buyers around the zone. Let's move over to Bitcoin. So Bitcoin has been, frankly, disappointing on its rally so far. BTC shorts continues to decline. So it's not like it's the whales here. I don't think the whales are necessarily manipulating the cryptocurrency. I think it's probably the futures market and Wall Street itself. If you think about it, when you introduced futures markets into cryptocurrency, that allows a lot of manipulation to occur from the crypto space. And this manipulation then goes through the week. And of course, that's why you tend to generally see those bullish kind of actions going on the weekend, because it's more the retail traders or the whales. And the whales only attack the market sometimes. The good news is the market did fall down, but at least it got held by around that 47.5K. We've had previous buying pressure there. We didn't quite get through there now yet. And I think the problem is we get underneath 47,000. Oh, here we go to 42,000 again. That is not going to be pleasant. So I'm sure many of you don't really want that. This area here, we do not want it underneath 47,000 if we can help it. Recovery now is set for this 49.7 area. If it then breaches through that, fantastic. But all we're looking for now is hopefully a recovery sign. And it's still a little bit early. 2 hour time frame showing a little bit of base. Let's go down to the 15 minute. 15 minute here, you can see the trend is starting to maybe improve. So if we took like a line chart through here, maybe drew these last kind of peaks, you can see what I'm looking at. It's really just a continuous decline of the market. We're hoping for that to breach. And then once that breaches, the smaller timeframes are starting to repair. So if you're a smaller timeframe trader, this is one of the things you're looking for. You're looking for this continuation of weakness. I mean, the 50 moving average here, the exponential has been weakening. You can see that's the sign of really where it's been selling 1, 2, 3, 4, 5 times, or 1, 2, 3 in this case. And then we also have that trend line down. We're looking for a snap of that, and then buyers will come back in, at least on these smaller timeframes. And as the smaller timeframes pack together with more and more buyers, the bigger timeframes confirm, and we can get in on those trades. Ethereum, yep, it's the same thing as usual. Still holding up pretty strong. It did fall off. It's not as strong as it has been in recent days, I guess you would say. It shouldn't have maybe fallen as much as it did. At one point there, it fell around 9%, which is more than Bitcoin really in some ways. But look, if we do get the recovery, that would be fantastic. 4,000 still is the fortress for Ethereum. So 4,000 still a very, very strong zone. and any break above that 4,700 is going to be where the bulls really take control of this market, and hopefully we get a lot of rallies through alts and everything at that stage. Let's move over to the big news that everyone's waiting for. It's CPI data. That's the excuse being used for the sell-off. I tend to think it's more of an excuse than anything else, but a lot of this data is excuses. PPI, CPI, whatever, GDP, whatever else number you want to throw at it. In general, the big things you want to look at is what is the Fed doing? What is the government doing? And of course, are there any black swan events that really are epically bad? And outside of that, all of this information tends to be mostly noise. Sometimes it can be completely drastically different from what they expect and it can move, but most of them aren't like that. And remember, how often do you always need to ask yourself this question, how often do you remember the CPI data the next week or 2 weeks later? If the answer is basically never, and that is pretty much with most of this bits of news, then you can see how much of it is mostly useless, and it's used more as an excuse than anything else to move these markets around in the way that they were already going to move. Thanks so much, guys. Make sure you subscribe if you enjoy the videos. Give us a like if you enjoy them as well. It does help us out. And thanks for being the most awesome community on YouTube right now. Catch you, everyone. Bye.